Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 24th of October, 2019. And so far this week, we've been focusing much more on gold, whereas last week it was on silver. Now, yesterday we produced a video entitled Gold versus the Dow Jones, a brief assessment. And in fairness, it went out a little late in the day, so if you haven't had an opportunity to view it, we've placed a link in the description box below. Now today we're going to look at gold versus bonds in an investment portfolio and look at whether bonds will now serve as the obvious candidate for those looking for defensive investments when there is much peril around. So let's investigate. Firstly, some of you may be aware, and others may not, that the narrator of this channel, that is me, has held senior positions in a bank, an investment house and a wealth management company in Switzerland. Now, whilst this channel does not pretend under any circumstances to offer or suggest any form of investment advice, that does not mean that we cannot take into account and reveal to you what investment managers and advisors are currently considering, thinking, or likely to act upon. It is this background and training, coupled with continued associations with central bankers, politicians, hedge funds, and investment managers, that to some extent give us an edge over other YouTube channels, who do not have such credentials or associations. It also gives us a clear insight as to where investment trends are heading, and what these managers who, from the sheer weight of their funds and portfolios, can often dictate or at least influence market prices. Now, all that said, what we try and do is to decipher and lay out in hopefully non-technical terms what is being considered and what is then likely to happen. It's not a precise science, as not only do such firms use algorithms, often different ones, but some have built into their systems a degree of human intervention, which by any standard will possess a degree of emotion as opposed to hard, cold, objective logic. It is no secret that in recent years, and we've shown this in recent previous videos, that those who have invested in stocks or equities since 2008 and 2009 economic collapse have done extremely well in general. Also, those investing in government bonds have also done well, considering they are generally regarded as a defensive asset, secure but unexciting. Gold and silver have done well until 2011, and between then and 2015-16 have performed abysmally, with gold peaking just below $1,900 in September 2011 and silver $49 in April 2011, when compared to their current prices of gold, $14.91, and silver at $17.57, they have lost since those peaks 21% and 64% respectively, despite considerable rises over the past couple of years. The question on fund managers' lips today is, are things going to change in the precious metals space, and especially for gold? Now, until now, gold has been seen essentially as either an inflation hedge or a currency devaluation hedge, or at best, a defensive asset class, to which only a tiny amount of one's portfolio, if any at all, should be allocated to it. It is often cited that gold bears no yield and therefore is uninteresting to investment managers who are under continual pressure to produce results, not just year after year, but quarter after quarter, for fear of either losing their own jobs or the funds which they are managing. From a defensive asset point of view, they have tended to prefer bonds, usually but not exclusively government bonds or, as are often called, treasuries. They are safe in that they are backed by the government, and they have up until now offered, not exciting, but generally inflation-beating yields. But that time now appears to be over. We've seen yields fall significantly around the world, and the prediction is that they're moving lower, with something like $15 trillion worth currently offering negative interest rates, and this will only increase. There is no doubt that investment managers and advisors are now considering gold, and to a lesser extent silver, as a viable option or alternative. Now we're going to read to you, written in last week's Financial Advisor, an insider magazine or newspaper really, for the advisor fraternity, an article entitled, quote, "Bonds Still the Best Safe Haven?" unquote, written by Saloni Sadana, who is the FT Advisor's feature writer. In this article, she addresses the issue of the best defensive assets to own, especially when one is skeptical about the ongoing threat of a major stock market correction. She addresses the recent inverted yield curve, which we've produced a video on and placed in the link below in the description column, and also addresses whether gold is another option as a safe haven asset. The article is a little technical and lengthy, but has some interesting quotes by various investment managers. So here goes. Bonds still the best safe haven? Defensive assets are often said to be the key diversifying component of multi-asset funds. Bonds were universally regarded as the ultimate defensive asset for a very long time, but a period of low yields has called into question whether fixed income is still the best way to achieve an optimal multi-asset portfolio. So what are defensive assets, and which ones should clients include in their multi-asset portfolios? Jean-Marie de Beaumarche, multi-asset portfolio manager at CPR Asset Management, says defensive assets are an important part of a multi-asset portfolio construction process due to their low correlation properties. She adds, their lower beta and or uncorrelated features with traditional risk assets are useful to improve the risk-reward profile of multi-asset portfolios. Joachim Thielmeier, investment consultant within the Dynamic Solutions team at Natixis Investment Managers, says, quote, "There are many risks to consider for an investment portfolio, but in terms of volatility, defensive assets can reduce risk in two ways, or a combination thereof. First, be less volatile than the portfolio, or second, have lower correlation with other asset classes in the portfolio," unquote. But Jim Schmielgiel, Chief Investment Officer of Non-Traditional Strategies at SEI Investments, point out that the definition of a defensive asset varies in line with market conditions. Quote, "Investors tend to associate bonds with a defensive label, given the actions of global central banks since the financial crisis. In reality, there is no Swiss Army knife defensive asset. Therefore, investors should focus on diversifying assets which allow for higher levels of risk-adjusted return," unquote. But the industry is divided as to the importance bonds play in multi-asset portfolios, since the asset class has come under increased scrutiny in recent months due to low yields. In August, the yield curve inverted, sending a signal that the bond market may be predicting a recession. The yield curve is a visual representation of how much it costs to borrow money for different periods of time. An inverted yield curve has preceded every single recession since the Second World War, but not every inversion has been followed by a recession. It should typically cost more for a country to borrow money over a longer period of time. This is why longer-term bonds usually yield more than shorter-term bonds to compensate investors for taking on greater risk. But this relationship has flipped in recent months, as 3-month US Treasury bonds have yielded more than the 10-year US bonds. The main reason why bonds played a key role in multi-asset portfolios is due to their low correlation to equities. Ms. de Beaumarche says, quote, "The lower bond yields go, deep negative territory like German or Swiss debt, the lower their diversification, defensive benefit going forward. as both their carry and price gain potential become less appealing, unquote. Mr. Thielkemeyer says, since equities are often the prominent risk driver in a portfolio, assets that do not have correlation with shares are very useful for diversification purposes. Quote, historically, these assets have been fixed income. However, in this extraordinary rate environment, some categories within fixed income may no longer provide the risk and return profile investors are looking for in defensive assets, unquote. But he points out that bonds with a lower duration can still be defensive in nature amid an environment of low and even negative yields. Nick Watson, portfolio manager in the multi-asset team for Janus Henderson, says, quote, investors can choose to allocate more to short-dated or lower duration bonds, which arguably offer compelling risk adjustment returns relative to longer-dated bonds given the current shape of yield curves, unquote. The risk is certainly rising for higher duration debt. Mr. Watson explains, quote, with much of the monetary policy exhausted, the argument for fiscal expansion from more populist leading governments is building. More government borrowing, spending and infrastructure investment would suggest higher inflation, which is a different environment to that of the past decade and would pose challenges for high duration defensive assets, unquote. While bonds are still deemed partially attractive, experts point out several other defensive assets that can provide similar diversification benefits. Gold remains a popular asset class to include in multi-asset portfolios as a safe haven to mitigate geopolitical risk. Mr. Schmiegel says, quote, exposures like gold offer opportunities to protect against geopolitical events and general financial calamity. It's important for investors to maintain diversified exposures to various risk premiums at a total risk level with which they're comfortable, unquote. Damian Barry, head of multi-asset multi-management for Mediolanum International Funds, says gold has proven to be a valuable investment when equity markets are in freefall, as happened in 2008. But he warns that gold does not yield any regular income. Quote, the caveat is that gold doesn't produce any income, so it can drop relatively quickly, as it did in the second quarter of 2013, when it lost almost 25% at the time of the taper tantrum, adds Mr. Barry. Now, the taper tantrum was a period of panic that caused a spike in US bond yields after investors found out that the Federal Reserve was intending to cease its quantitative easing program. Mr. Watson says, quote, asset allocators can express a defensive stance within their equities by allocating to high-quality defensive companies. Alternatives, such as infrastructure assets or gold, also have defensive characteristics with complementary return streams to equities and bonds, unquote. Some in the industry have suggested that cash and exposure to foreign exchange can also be a defensive strategy. Mr. Watson says, quote, cash is a tactical tool for dampening volatility and managing drawdowns. With bonds and other defensive assets looking expensive versus history, cash may prove to be better protector of capital than conventional bonds, unquote. Mr. Schmiegel thinks commodities and other inflation-sensitive assets are good alternatives to the current state of bonds. Again, quote, given the recent performance of these asset classes prior to 2019 and the general outlook for inflation, we tend to believe this is an under-owned part of the capital markets that can be extremely diversifying to an investor's portfolio, unquote, he adds. End of article. Now, we are aware that this video podcast is becoming quite long, so we shall have a short conclusion. If there is one message one can derive from this, and we have to bear in mind that not every asset manager or hedge fund manager or investment advisor is in total agreement, but one can now draw the conclusion that moving forward, despite the lack of yield, gold is now at last becoming a serious consideration in being included in a multi-asset portfolio, primarily for defensive reasons. But even if gold replaces a small percentage of those monies allocated to bonds previously, we shall indeed see an uplift in prices from current levels. Will this happen overnight? No. Funds and managers take time to move such assets and, frankly, to be persuaded they're doing the right thing. No one wants to be managing an underperforming fund. But do not be surprised that over the coming months, and certainly the next few years, we shall see gold gaining in prominence. The first move might very well be simply to cash, expecting an equity collapse or fall, only to go back into equities again. But they need that defensive measure. So we doubt that you will see overnight $10,000 an ounce gold prices. But we should see gradual and slow but steady uplifts, with pullbacks and consolidations. But until the world manages, if it ever does, to get out of economic depression, stagnation or recession, whichever applies, then we can expect gold's luster to shine for a number of years to come. Thank you for listening. Do share your thoughts, and if you haven't watched either our gold inflation hedge or gold versus Dow videos, then please do so. And as mentioned earlier, we've placed links in the description box below. And finally, please do not forget to subscribe to this channel if you haven't already done so, and pop over to illuminatisilver.com and join our inner sanctum. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.